Right now, $6 billion in life insurance benefits sits, waiting to be claimed. The companies owe it, the families deserve it, but no one is coming to find them. In the next 9 minutes, we're going to change that. Insurance is the oldest financial product in human civilization. Ancient Babylonians used risk-sharing contracts for merchant ships 4,000 years ago. But the modern insurance industry is something else entirely. It's an $8.3 trillion global machine, and 40% of it is right here in America. Here's the fundamental math they don't teach you. Insurance works because most people pay in, and statistically most people don't collect. You pay your premium. The company pools that money with millions of other premiums, and they invest it. For every dollar you pay in premiums, insurance companies collect interest and investment returns before a single claim is paid. This isn't evil, it's actually brilliant. The idea is that your small, predictable payments protect you against a large, unpredictable loss. A $150 monthly premium is worth it to avoid a $150,000 hospital bill. But, and this is the part that matters, that equation only works if you understand exactly what you're buying, and most Americans don't. A KFF survey found that 44% of U.S. adults find it difficult to afford healthcare costs. Even more stunning, 62% of people who already have health insurance worry they can't afford their own deductible. Think about that. You're paying hundreds of dollars a month for something you're afraid to use. Let's start with life insurance, because this is where the biggest mistakes happen. There are two kinds, term life and whole life. And if you've ever talked to an insurance agent, you know they love to complicate this conversation. Term life is simple. You pay a monthly premium for a set period, 10, 20, or 30 years. If you die during that term, your beneficiary gets the payout. If you don't, and statistically most healthy people who buy term insurance in their 30s won't die during the term, the policy expires and you get nothing back. That's the deal. No surprises. Whole life insurance, sometimes called permanent life or universal life, combines a death benefit with a savings component. Your premiums are significantly higher, but a portion builds what they call cash value over time. Agents sell this as an investment. Many financial experts argue you're better off buying cheap term insurance and investing the difference in an index fund. Run your own numbers. This decision depends on your age, health, and financial goals. But here's the thing that should make every American stop and check right now. $6 billion in life insurance benefits goes unclaimed every single year. How? Simple. People forget to update their beneficiaries. A policyholder dies. The family doesn't know the policy exists. The insurance company is legally required to pay the benefit, but they are not required to track you down and find you. The National Association of Insurance Commissioners runs a free policy locator service. Since 2016, it has resolved over 312,000 cases. Check it today, especially if you've lost a parent or grandparent in the last few years. Health insurance in America is its own language, and that's not an accident. Let's translate it. Your premium is what you pay every month just to have coverage, whether or not you use it. Your deductible is the amount you pay out of pocket before your insurance starts covering costs. Your copay is a flat fee for specific services. Your coinsurance is the percentage you pay after meeting your deductible. And your out-of-pocket maximum is the most you'll pay in a year before insurance covers 100%. In 2025, the average deductible for employer-sponsored health insurance was $1,886 for a single person. If you buy your own insurance through the ACA marketplace, you're looking at far more. A bronze plan carries an average deductible of over $7,400. The out-of-pocket maximum for 2026 is $10,600 per person. This means that if you get seriously ill, you could owe $10,600 before your insurance truly kicks in. For a family plan, that number doubles. So what do? First, know your network. Every plan has a network of doctors and hospitals that have negotiated rates. Go out of network, even by accident, even in an emergency, and you could owe far more than expected, or find your claim denied entirely. Second, understand prior authorization. Many procedures, specialists, and medications require your insurance company's approval before you get the service. Without it, the claim can be denied. even if your doctor ordered it. Third, and this surprises people, understand that you can appeal. Insurance companies are required to have an appeals process. About 40% of denied claims that are appealed are overturned. Now let's talk about the insurance most people deal with every single day: auto insurance. Every state requires it. Most people carry the minimum, and that minimum is where the danger lives. Here's what auto insurance actually covers, or doesn't. Liability coverage pays for the other person's damages if you cause an accident. It does not cover your own vehicle or your own injuries. Collision coverage pays for damage to your vehicle from an accident. Comprehensive coverage pays for non-collision damage, theft, weather, a deer walking into your path. Uninsured motorist coverage protects you when the other driver has no insurance. And in the US, about 1 in 8 drivers is uninsured. Here's the statistic that should scare you. In New York, auto insurance companies denied 48.3% of all liability claims in recent data. Nearly 1.3 million denials. That's a 44% increase in denial rates over the past 2 decades. Why are so many claims denied? Coverage lapses from missed payments, policy exclusions buried in the fine print, filing too late, and one you may not have thought of: your social media. In 42% of disputed claims, social media posts were used as evidence to deny or reduce payouts. Photos of you active and healthy after claiming an injury, a check-in at a location that contradicts your timeline. Insurers have entire teams dedicated to monitoring claimants' social media. After any accident or injury, lock your accounts and share nothing publicly. The gap between what you think your policy covers and what it actually covers is exactly where financial disaster lives. So, what can you do? Here is the practical playbook. Number 1. Read your policy. Not the summary, the actual policy document. Every exclusion, every condition, every coverage limit is in that document. Most people never read it until they're filing a claim, which is too late. Number 2. Document everything. After any accident, before you move anything, photograph everything: the vehicles, the road, the weather conditions, the traffic signs, any witnesses. Get a police report even for minor accidents. The moment you think you might file a claim, start a paper trail. Number 3. File immediately. Every policy has a reporting window. Miss it, and your claim can be denied regardless of merit. When in doubt, report the incident the same day. Number 4. Never give a recorded statement without understanding your rights. Insurers may ask you to give a recorded statement early on. You are generally not legally required to do so immediately, and anything you say can be used to reduce or deny your claim. Number 5. Appeal everything. If your claim is denied, request the denial in writing with specific reasons. Research whether the denial was valid under the actual terms of your policy. Submit a formal appeal, and if that fails, contact your state's Department of Insurance. They oversee insurers and handle consumer complaints. Insurance exists to protect you, but only if you understand it, maintain it, and know how to use it when you need it most. Check the NAIC Policy Locator. Read your policy. Document everything. Appeal denials. If this video changed how you think about insurance, hit subscribe. Insure Smart breaks down the policies, the math, and the moves that protect your money every single week.